Rachel, and I often get asked, what do you do? And really behind this question, I want to answer for you what it is that I do for you and why it matters and why it's important for you to really pay attention to the financial conversations around you and why you're making the decisions that you're making. Is it just because everyone else has been making the same decision? Or you're automatically enrolled in a 401k? Or because everybody else is investing in the stock market? Or everyone else is trying to increase their retirement plan? What I do helps put you in a position of control of your finances. What does that mean to be in control? What I know is that too often people have money flowing out of their control. This is money flowing out through taxes and to banks and financial institutions. Now, why is that even bad that we have money in the control of banks and financial institutions and the government? Well, it's not bad unless you want to personally be in control. Because here's what I know. Every time that you put money into another financial institution, that becomes their income. You might be storing or investing somewhere, but that now becomes an asset on their balance sheet. They take that capital and they create more capital with it. They're using and leveraging your money to create cash flow for them. And why wouldn't they? They're excellent at what they do. That's why banks and financial institutions have some of the most profitable business models in the world. Now, instead of just positioning ourselves to profit the banks and financial institutions, I want to put you in a position where you are personally profiting. How do we do this? By taking back that control and having as much of our money in our control. What does this actually look like? It looks like being mindful of the best tax deductions that you can take so that you pay as little as legally possible in taxes. The tax code was written to benefit the business owner and reward the person who's the producer in our culture and society. It's not about loopholes. It's about leveraging the tax code in your favor and paying the minimum legal tax. Then we're looking at how can we make sure that you're in a position of financing as effectively as possible so that you're not just being a customer of the bank, but you're being the bank. How do you be the bank? You be the bank by having capital that you own and you control and you can use, just like the bank does. This means that you have capital that's growing, that you can access, you can leverage against for emergencies or opportunities, specifically to increase your cash flow. When this all comes together, here are the three main financial objectives that you want to accomplish. One is that you need a place to store your liquid cash. This needs to be a place that has guarantees, that's not going to drop in value because the market dropped. You also need a place that you can access this money. It needs to be usable for you. You need to be able to borrow it or borrow against it. Either use that money or leverage it by using it as collateral and borrowing someone else's money to use. It also needs to have some growth, specifically over 3%, because that's at least the minimum inflation, and we need to keep up with inflation so that you're not going backwards on your cash accounts. You need to be able to keep up with at least a growing rate of inflation. So, we need to have a place to store cash. The second thing that we need to accomplish is that we need to be in a position of gaining cash flow. This is money coming in on a regular, consistent basis, and specifically not from your day job. So this is money that's coming in, being produced by your assets, something that is producing a monthly or quarterly or annual return that's not just growing the value of the asset, but it's actually putting cash into your pocket. We're also looking for a third objective, and that is how do we get real, true growth on our money? Not growth that might go up and might come back down, maybe evening out or maybe having a little bit of growth over a span of time, or essentially just gambling on our money because we're not sure if we're even going to keep what we put in or if we might potentially lose all of it. We want true growth on our money, and this would mean true returns. Ideally, double-digit returns with a guaranteed no loss of principal. Why is this all important in your life? What my objective is in setting somebody up financially is to help them to be in a position where they have control of their money so they can truly prosper outside of the fickle and gambling and there's a word I'm looking for, tumultuous environment of Wall Street, where they can truly be in control so that they can have confidence and know where they're going to end up in the future. I want to help you increase your cash flow through assets that produce cash flow. I want to help you save where you have safety, liquidity, and growth, and have a cash flow banking system according to the infinite banking concept that allows you to improve your access to capital, boost your returns, earn consistent, uninterrupted compound growth, reduce your risk, and have access to your money so that you can leverage it to take advantage of other opportunities and essentially stack your investments where you're earning a rate of return on your cash and you're also earning a rate of return on your investments. So how does this actually look in real life? We help somebody with a financial picture exercise, and this helps them to understand where is money flowing out of my control currently that I don't see, but I'm wondering how I can have more of that flow back into my control. After we help them recognize what they can do to maybe structure debt differently, or change the tax deductions that they're taking in their business, or potentially finance differently, or repackage their debt in a way that they're paying less per month in debt payments, we're looking at a way to have more money come back into their personal economy per month from the dollars they're already making. This might also have to do with looking at where money's going out into qualified plans that might actually not be safe and guaranteed in the mutual funds that are being held, that the money is being held in. We're looking at how can we have more of those dollars go into positions that have guarantees, safety, and liquidity and growth. So I want to give you an idea of what this might actually look like for someone. I'm going to use an example of myself. I'm a 32-year-old woman, and I bring an income into our household. Now that provides me an insurability with life insurance that would replace my amount of capital that I'm contributing to the household should I pass away. So my cash value life insurance is going to do two things. It's going to give a death benefit that gives peace of mind to my family that if the income were to be lost because my life was shortened somehow, that they would be able to carry on and continue on without having to worry financially right away. The other thing that this is doing is it's giving me a place to store cash because it's growing this cash value component that I have access to. So it's growing with on a guaranteed basis. It's growing about 3 to 5% rate of return internally. So inside of the policy itself, without any other factors added, we're growing at about 3 to 5% tax-free rate of return. So I'm able to then use that cash value, and I'm able to use it by borrowing against it to use for opportunities to produce more cash flow or for emergencies. Now, in practical terms, this means if something were to happen and I needed $5,000 to do a repair on a car, or I needed $30,000 to buy a new car, I have the capital then in my cash value to be able to do that. And how do I use the cash value? I actually don't use my cash value. I borrow against my cash value and use the insurance company's money. So I'm keeping my cash value growing even while I have it out doing work for me. Now, when I'm able to use this even more powerfully is in a cash flowing investment. So now let's say that I have grown my life insurance policy. It's adding dividends each year. There's no loss in the policy. There's no potential for loss. It's only growth. And this money is growing based on a dividend that is paid because I'm an owner of the company, being a owner of a policy that's mutual company. And then what happens is I'm able to use that cash value for a cash flowing investment. So one such opportunity is bridge loan environment, where I'm able to lend my capital to a company that either does commercial bridge loans, and this is lending to a commercial property for them to do renovations, or it might be purchasing a home through a bridge loan. And so I'm able to use my capital and earn a rate of return on a monthly basis with that capital, with that money. So let's just say, for instance, I had $30,000 of cash value in my life insurance policy beyond what I wanted to keep for an emergency fund. So let's say I had $30,000 for an emergency fund, and I had $30,000 on top of that, a total of $60,000 of cash. I could use the $30,000 at the top, borrow against that, and go use that in a bridge loan that is going to produce for me 8% per year on a ongoing basis. So what that would do is my $30,000 would stay in the policy. The next $30,000 would go out to the bridge loan. That would return 8% for me. So let's just do a quick calculation and figure out what is 8% of 30,000. So 30,000 times 0.08. So that would be $2,400 would be paid within that year. And so what I would do is I would get cash flow, cash money to me of $2,400, and I would use that to help repay my loan against the life insurance policy. So that is providing me a position where I have the $30,000 still remaining if I had an emergency. The $30,000 at the top is borrowed against, and so there's a lien against that, and I can't use that at this time. It's a loan that I've taken from the life insurance company. I'm using that $30,000 over here, producing an 8% rate of return. And then after 2 years, this principal returns back to me in full, and I'm able to fully pay off the loan. So I'm in a position where my money is actually working in two places at once. It's working here in the life insurance, earning me a return here, but it's also working for me over in this outside investment. So I have an internal rate of return, and I also have an external rate of return. So now I'm in an environment that I'm getting my money to multitask for me, and I'm growing my cash flow quicker. And what's happening is that as I'm able to increase my cash flow either through other assets or through other income or other investments another way, I'm then able to convert my term life insurance over to more whole life insurance and more quickly grow my cash value, have more cash that I'm able to use in more cash flowing investments. And in doing this strategically so that I have both working for me at the same time, I'm significantly able to increase my financial freedom, and this time frame, the time horizon from now to the time frame of being financially free, because I've taken a position of being the bank, having that capital liquid and available to me with guarantees and growth, and I'm finding ways to produce income that's outside of my personal working income. I hope that all makes sense. I will talk with you next time. Thanks. Hi, this is Rachel. I hope you enjoyed this episode of Money Secrets. If you did, like this video, subscribe to our channel, and leave a comment below. I would like to invite you to get your free cash flow generator to help you start keeping more of your money. Come on over to marshallsinsurance.com/cashflowgenerator to sign up.